Today's flash is entitled Animal Spirits versus Earnings, and I'm trying to temper my animal spirits, focus very much on the earnings, and my setup at the moment is slightly cautious. Now, I haven't seen you all since November the 10th, and since then we've had a big year-end rally, and we know why. Soft landing nirvana, inflation's falling faster than expected, the market's very quickly priced in the pivot, at least 3 rate cuts in 2024, and the herd has moved in. Money has poured into equities. Now, when you look at this first chart, you can see the reaction function for lower yields, higher equities is alive and well. It is so well correlated. It has been really for 15 years, right? Lower yields, risk on rally. Then we're okay with that, okay? PEs expand and the market's ever more confident that this big 12% recovery in earnings for 2024 plays out. No problem at all. And $70 billion has flowed into equities into December. That's the biggest number for nearly 2 years. And $45 billion flowed into the S&P Tracker ETF. That's the biggest number since 1998. So we get it and we're okay with it. Now, of course, we're entering Q4 earnings season and earnings have got to start to deliver. But when you have a look at the bar chart of the earnings profile per quarter, what this doesn't tell you is that although Q3 earnings last year beat, they came in up 5% versus 1% consensus, Q4 earnings have gone from up 8 to up 2. So the market's rallied for the reasons that I've mentioned, and that's great. But earnings have been tracking the wrong way. They've gone from up 8 to up 2. Now, whether or not companies are lowballing for easy beats, well, that remains to be seen. So what my note of caution is really based upon is that the market has priced in these earnings numbers to come through. And I'm just asking myself, just because yields are lower, just because the Fed might cut from 5.25 to 4.5, does that really shoe in these great earnings numbers? PE expansion, I think, is broadly priced in. Earnings have got to come through. Now, when we look at stocks that have reported, important stocks that have reported over the last few weeks, what have we had? Well, we've had Nike, and they were down 10%. FedEx, they were down 10%. Mobileye, which is quite an interesting stock for the EV supply chain, that was down 25%, and the markets broadly ignored them as indicative of what might be ahead because, of course, the herd's in charge, it's risk on, yields are lower. And we're told all the time how strong retail sales are, and the data has been really, really good. When you look into a bit more detail, looking at something like Adobe Analytics, what worries me is that discounting in some of the key categories like electronics and apparel has actually been greater this Christmas season than last year's. And we've been told, or we know, that the retailers are now right-sizing their inventory. They've had much better inventory management, which hopefully would suggest that their discounting would have been less, meaning their profit would be greater, but that's not happened. So here's another little warning sign saying, yeah, the market's up because yields are down. Is that going to guarantee that earnings come through? You know, not having a recession is great. It means we don't have to derate for lower earnings in a recession. But if growth normalizes and gets smaller and smaller, that means 2024 earnings estimates get further and further away. And of course, yesterday, we had the ISM services. Now, we know manufacturing's been in a hole for 14, 16 months. What's kept the US economy going is the ISM services. And yesterday we had a big miss, fell just above 50. So it's still expanding. On the face of it, it looks like perfect soft landing data. But of course, as traders, rates of change matter. And I asked myself, is it possible that ISM services could contract from next month? Well, if that's the case, we've got manufacturing contracting, services contracting. Why on earth do we think we're definitely going to get the big earnings numbers priced into the market? So there's another risk. Now, the labour market data has confounded all and sundry, and I'm not a conspiracy theorist at all, but there are a couple of interesting charts. The first one is the average hours worked per week, and you can see that it's now completely normalised back to pre-pandemic levels, and we understand why there was labour hoarding. The market is still tight. There's probably a structural shortage of workers, and these workers were working longer and longer hours, which is a good thing. Now, of course, those hours have reduced. So again, this makes me think that if demand falls a bit faster than expected, these workers then may start to lose their jobs because they can't have their hours reduced too much from here. So that is a potential sign that just maybe things aren't as good as we're led to believe. But this second chart really is interesting. So this just shows the response rates from companies who submit data to the Bureau of Labour Statistics, right? This is where the data comes from. And you can see that, generally speaking, 60% of companies respond to the survey. That's now fallen to sort of 40% for the non-farm payroll and under 30 or 35% for the jobs. Now, considering the Fed has hung his hat on labour market data, if so few respondents actually send in data, I'm assuming that the Fed has to fill in the gaps. Now, I'm not a conspiracy theorist. You have to trade the data you're seeing. But again, as we go through full year, there are a lot of seasonal adjustments in the data, and January and Feb can be outliers. So I'm not even sure how good the jobs data, whether the jobs data is good as what we see. So all of this comes to my final conclusion. I understand why the market's rallied with good reason. The market's very quickly priced in the pivot. My book's only 75% invested, and that's because I think the macro is still quite murky. I'm not really sure what the pain trade is. I know that there are as many bears as there are bulls. I know the reaction function is lower yields, everything goes up. I'm looking at what companies have reported, what they've been saying since last earnings season officially ended and before JP Morgan next Friday starts. They haven't been good. Q4 earnings are getting downgraded. ISM services has fallen to just above 50. So before I decide whether animal spirits are going to prevail and I want to get long, or likewise earnings aren't going to come through and I'm going to get short, I've got plenty of ammunition, plenty of room for my book. And the beauty of trading long-short equity options in a portfolio and being focused on absolute return is you don't have to force it, you don't have to chase it. If you don't have a strong view, do not have a strong view. Long-short equities, no real sector biases. It's a fine way to be. Have plenty of ammo because all we know from really the pandemic started is consensus is a dangerous place to be and nothing's playing out as expected. So get ready to do a lot of reading with all these earnings coming through. Pick your stocks carefully. Don't chase. You can't win 2024 in January. Trade accordingly. Good luck. Good earnings season. I look forward to catching up with you in February.